Hi everyone, welcome back to the US individual taxation classes enroll agent part 1, taxation and advice. In this particular video, I'll be walking you through very interesting topic which is tax planning for individual. So let's understand what all tax planning we can do for individual in United States of America. Hi everyone, welcome back to the US taxation class after the very long time. Now today we'll be completing chapter 4, the last topic, which was tax advice for the individual taxpayer. If you remember, before this, we have completed uh, the taxation part, the alternative minimum tax and credit for the period. This all we have covered: penalty, exception, household employee, underpayment of penalties, interest, condition of filing of claim and refund, self-employment tax, excess social security withholding, tax provision for member of clearage, and income in respect to descendant, healthcare, individual responsibility payment, net investment income taxes, and additional Medicare taxes, and then uncorrected social security and Medicare taxes, other taxes. For this, like we covered through the book, I still need to share the notes for this. But today we'll be starting with this 4.2, which is tax advice for the individual taxpayer. So today we'll be covering all these 12 topics, out of which so far like I have made the notes for 4.2.4 so far, so which I'll be sharing with you immediately, and rest of the topic will be covered from the book, but maybe like around 10:30 or 11 o'clock I'll send you the complete you can say notes for 4.2 today. So without wasting much of time, let's jump into the first one, 4.2, tax advice. So what comes in your mind when you think about tax advice? That means you are advising the individual how best he can you can implement the law and make sure like his tax liability would be minimal, or he'll be complying with the all regulatory requirement, right? Yes or no? When you think about advising tax for an individual, what comes in your mind generally?
वो ये कम से कम टैक्स लगे हमारे उसका
Mm-hmm.
जिनके हम रिव्यू कर रहे हैं
Mm-hmm. Yep. Divya.
अंडर द लॉ हो, ये ना हो कि इधर उधर कर दे.
Mm-hmm. Yep. Garima, Divya, any thought?
सर प्रॉपर डॉक्यूमेंटेशन हो, प्रॉपर मेंटेनेंस हो डॉक्यूमेंटेशन का.
Mm-hmm. Yeah, Shubham, anything from your side?
ये सब टैक्सेस में लाइक उसे सबसे ज्यादा बेनिफिट हो when we like he according to his जो उसने assets में इन्वेस्ट करा है उसके अकॉर्डिंगली लाइक रिटर्न आए, क्रेडिट रिटर्न आए.
Mm-hmm.
उससे हम टैक्सेस के बारे में
Mm-hmm. Yeah. If you remember, like so far, if you go back to the very first class, if you go back to this very first class, here we have studied all this, like calculation of taxes for the individual. So there we understood what all comes in a gross income, what all comes in deduction. Then we discuss about like standard deduction, itemized deduction. Then we discuss about tax credits and withholding tax, right? Here we discuss a lot of things, like what all things can be considered as a deduction from the gross income. When should an individual choose standard deduction, or when should an individual go for an itemized deduction? Which one is more beneficial to the individual to minimize their tax liability? And then also we discuss certain tax credit. And there also we have seen certain item which you have contributed or which you have deposited or which you have paid, you can consider either as itemized deduction or the tax credit, right? So those are like certain, you can say, calls, or certain, you can say, suggestion or certain advice as a tax practitioner you can give to the client, right? So what is the key objective of tax advising is, first one, like how to calculate and report the taxes, which will be most beneficial to the taxpayer and which will also reduce the burden of proof on the taxpayer. For example, if you choose standard deduction, then probably there is no burden of proof, or there is no requirement to submit any additional documentation when any tax, you can say, any assessment happen, or any, like when IRS may ask for any question, right? Because that is being already given by the law. Same way, there are so many other things which we have studied in last couple of classes that can be used to minimize the tax liability of the individual client, as well as can help you reducing the burden of on you to prove to the tax authority why you have chosen this particular exemption, or why you have taken that particular stand. Third and important thing is like the documentation. What all tax records you need to maintain, and what all documentation your client is required to be maintained. So these all comes under high level is the tax planning for the individual, because like enroll agent part 1 is completely for the individual taxation. So here whatever we will be studying will be based on the individual taxation. So everything so far, if you have seen, whether it's like calculation of income, deduction, standard deduction, itemized deduction, or maybe tax credit, what all we have studied is all we have studied in context of the individual taxpayer. So here also, for the tax planning, when we are studying, we'll be keeping in mind the individual taxpayer, right? So first thing, like principally, when you think about advising the individual for the taxes, so three things should be the principle in your mind. First one is how to calculate and report the taxes. Second is what will be the most beneficial position for the taxpayer, in which burden of proof will be minimal. And third one is appropriate tax records and the documentation. And then second thing is reporting requirement. So in this entire tax law, when we have studied from like class 1 to now, we have seen that there are two type of reporting requirement. One is like 1040, which is income tax return of the individual. And then there are certain additional reporting requirement. So additional reporting requirement, if you have some foreign income, then you need to report 1042S, right? If you have like any miscellaneous income, you need to report 1099. If you have done any withholding of taxes, then you need to report separately. So these are few additional requirement in addition to reporting requirement of 1040. So do you remember 1040 is? What is form 1040?
It's a US individual income tax return. United States individual income tax return.
Right, Garima, Vivek, hope you remember that form. We studied multiple times, and I've shared with all of you in class 1. I think this is form 1040. Right, hope you remember this. We have studied
Yes, sir.
multiple times, gone through multiple times, right? Recall this one.
Yes, sir.
Okay, now coming to the tax planning part. So when we are studying the tax planning, we'll be studying these 11 things. Tax planning could be possible in the area where there are, like benefit of law, or maybe different assumptions, presumption that individual can take to minimize the tax liability, right? That can be the area which include like sale of property. What is sale of property? You remember what is sale of property?
Real and personal sale of property.
Yeah, absolutely true. Real property and personal property. Then after planning for education, if you remember in the itemized deduction and tax credit, we discussed a lot about educational tax credit. Like this one is lifetime learning. Then second we discuss about American opportunities, right? So hope you remember those
Yes, sir.
itemized deductions
Yes,
and
sir, yes.
tax credits points, right? So it will be covering, like here we are summarizing what we have already studied. We are not going to study anything new, but we'll be studying in a way you should be recommending the client or advising the client. So all whatever is coming in the tax calculation. So if you remember, this is a tax calculation. We have already studied what is gross income, what is deduction, what is standard deduction, itemized deduction, tax credit. So nothing is new we'll be studying, but how you need to give the, you can say, recommendation or advice to the client to minimize their tax liability and ensuring he or she is in compliance with the tax law. Second one is, third one is planning of estate. Do you remember like estate tax? How much is lifetime deduction? Do you remember something? We discuss planning of estate tax, gift tax. We discuss in chapter 2. You guys remember or
ये
it's
स्टेट
gone?
टैक्स में सोशल सिक्योरिटी आता है या कुछ और?
No. Estate tax are like when you inherit the property.
Okay.
Right? For example, any let's
The
assume like
estate
any
tax is
individual
like
grandfather has expired and the grandson has inherited the property up to how much amount, like it is being exempt.
Okay.
So that's once in a lifetime, $11.7 million.
11.7. Yes.
Right. Same way like gift tax. So one individual can give the gift up to $16,000. So that may not be considered as tax. And both husband and wife, if they are married filing jointly, they can give up to $32,000 gift to one person. So these things can be used for the tax planning purpose. So it may reduce like tax liability in the hand of receiver, right? And then planning for retirement. So there we discuss retirement benefit plan. If you remember, there are three category of retirement benefit plan. One is like deductible traditional retirement plan and non-deductible, right? And then the Roth IRA, right? Hope you remember all those.
Yes, sir.
simple SCP 401k 403b.
Yes. 401k, 403b, yeah. So those all comes under the retirement planning. Then we discuss about marriage and divorce impact on taxes. So hope you remember in very first chapter when we are calculating the income. So we discuss about alumni. Sorry, we discuss about alimony. Sorry, we discuss about alimony. So before 2018 and after 2018, right? Hope you remember what was that before 2018 and after 2018.
Before 2018, it will come as like what is
Income and expenses.
Yeah,
expenses in the payer and the
yeah.
income.
The person who is receiving will be booking as an income, and the person who is paying would be considered as expense. But after 15 December 2018, it is neither considering income nor considered as an expense, right?
And child support is not allowed.
Child support will be still there, right?
Yeah.
Then future and past tax return impact. So if you have considered any stand of the tax law in the past year and now you are changing, so would there be any retrospective impact or would there be any prospective impact? So there might be certain you can say assumption you might have taken, or there might be certain correction in the previous year tax return. So how to consider the impact of those? That may be come under the tax planning. And then eighth one is planning for estimated tax and penalty avoidance. How can you avoid or minimize the penalty? That will be understanding. Next one is tax planning for adjustment, deduction, and tax credit. So this again coming to the calculation part. So whether we should choose standard deduction or itemized deduction. Within the itemized deduction, how to consider for medical expenses, state and local taxes paid, home loan interest, charitable contribution, investment expenses paid, and for the tax credit, like foreign country taxes paid, special tax credit, which is child care tax, education expenses, contribution to the qualified retirement plan, general business credit, or withholding tax. All those things we need to consider one by one. Then, if you remember, in very first chapter, we discussed about the filing status. What are the 5 category of filing status in US?
JMFS, HOH, and the last one is qualified with dependent.
So, individual filing, married filing jointly, married filing separately, head of the household, and qualified widower. Right? So that also have like certain different category of deduction. What is the most beneficial position? Married filing jointly or a qualified widower, right? What is the least beneficial position? Married filing separately, right? And then planning for health insurance, and lastly planning for the social security income. So these all 11 categories are where like tax planning is being possible. So we'll be discussing one by one in detail about the respective tax planning. So first, before jumping into first topic, let's do quick 2 questions. Which of the following penalties is a taxpayer likely to be assessed if they fail to keep adequate books and records when claiming the earned income credit? Which of the following penalty the taxpayer is likely to be assessed if they fail to keep the adequate books and records? First one is frivolous tax submission. Second is fraud penalty. Third is no penalty. And fourth is accuracy related penalty. What is the call of the question?
So option 4, yeah, because the EIC is generally related with the children, how many children you have.
No, what is the call of the question? It's not about EIC, it's more about adequate books and record. Fail to keep books and record when you are claiming any tax credit. Right? What is the call of the question? Vivek, Divya, Garima?
मतलब कैटेगरी में बताना कि कौन सी कैटेगरी में आएगी वो पेनल्टी.
Yes. So what is the call of the question?
अगर हम बुक्स और रिकॉर्ड्स उसके नहीं करते जो हम ले रहे हैं उसके डिडक्शंस वगैरह, तो उस केस में हमें कौन सी पेनल्टी मिलेगी?
Yes. What category of penalty would be levy if you do not maintain the adequate records and books to claim the earned income credit? That is accuracy related penalty. Means the EIC which you are claiming, whether it's accurate or not, if you do not have appropriate justified backup supporting document to that, right? Next question is Mr. and Mrs. Black Mr. and Mrs. Ben purchased their primary residence in 2013 and lived in it until they sold it in 2021. They purchased the home for $250,000 and sold in $650,000. Which of the following statement is correct? Okay, so this is more of sale of property, but I'm sure you have already studied, so might not be difficult answer for you. What is the call of the question? Mr. and Mrs. Ben, they have purchased a residential home back in 2013 and which they have purchased for $250,000 and now they have sold it for $650,000. Which of the following statement is correct? They are required to report the sale of their home on their 2021 tax return even though there is no gain. They are required to report the gain of $400,000 from the sale of their home on their 2021 tax return. They are not required to report the sale of their home on their 2021 tax return. They are required to report $150,000 from the sale of their home on their 2021 tax return. What is the gain? 650 minus 250. How much is it?
400,000.
400,000. And what is the exemption?
$500,000.
Yeah, when you're filing jointly, right? For individual 250,000 and jointly $500,000. So as the gain is less than $500,000, so they are not required to report, right? Vivek, Karima,
Yes, sir.
Divya, got it?
Yes, sir.
Yes, sir.
Okay, so let's jump into the first topic, sale of property. So sale of property, like we discussed earlier, there are two types of property, real and personal property, right? And real and personal property is also being further, like when you are discussing about the individual. So when we discuss about real and personal property, there we discuss about what is real property?
Which is fixed.
Which is fixed, like land, building. And what is personal property? Which is movable, right? And but here, when you are talking about sale of property from the individual standpoint of view, the capital gain will be considered on the sale of capital item and not for the non-capital item. Capital item can be real or can be personal, but first principally you need to identify whether the item which you am selling is being capital item or not. So capital assets include like assets for personal purpose, like for pleasure, investment, stocks, bonds, personal residence, household, furnishing, collection. Those all things can come under the capital asset category. Whereas non-capital assets are other than capital assets that are used for business purpose, like stock hold mainly for the sale to the customer, inventory, patents, intellectual property, etc. And the capital item, when you sell the capital item, it may result into capital gain or capital loss that you need to report on Schedule D. Do you remember Schedule D? Do you remember Schedule D for submitting the detail of capital gain or loss? Do you remember this form? Yes, no?
Yes, sir.
Yeah. Why I'm trying to open up this form again and again so that like when you are actually start working, you'll be familiarized with this form. Fourth point is capital loss cannot be claimed on the personal use assets sale. However, capital gain is required to report the sale on personal use assets. For example, if you have purchased a car of let's say $50,000, after a year you have sold that car for $30,000. That means you sold at a loss. Yes, no.
Yes.
Right. In that case, do you required to report the loss?
No, sir.
Answer is no. Right. But if you sold that car for $70,000 and you have gained $20,000, you required to report that gain.
Yes.
right? So that's what it means. The capital loss cannot be claimed on personal use asset sales. However, capital gain is required to report on sale of personal use assets. Fifth is a sale of partnership interest is generally considered as a sale of capital assets. What is partnership interest? What is partnership interest? Hmm? Do you remember what is partnership interest? We discussed in detail about partnership and S corporation. Partnership
पार्टनरशिप तो सर
interest
क्लियर है पर इंटरेस्ट नहीं समझ आ रहा.
no, partnership interest means share in partnership.
ओके, शेयर इन पार्टनरशिप.
Yeah, interest means like how much you are owning,
ओके ओके,
how much is the capital you have invested, how
मतलब
much per
मतलब इनकम फ्रॉम द पार्टनरशिप.
no, how much percentage of the partnership you are owning.
परसेंटेज ऑफ पार्टनरशिप.
Hmm? Partnership interest means like what is your share in the partnership, right? Garima, Divya.
अच्छा, अगर हम उनको सेल करते हैं फिर सेल दैट इंटरेस्ट. ओके ओके, देन द गेन दैट इज टैक्सेबल.
Yes, that will be considered as a capital gain. Garima, Divya, good?
Yes, sir.
Okay. Sixth point is sale of interest in a corporation is treated as sale of stock. So what does corporation mean here?
एस कॉर्पोरेशन.
S corporation and C corporation, right? So any sale of interest in corporation means considered as sale of shares. Stocks mean shares, right? Seventh is sale of business is treated as sale of individual assets of business individually. Sale of business is treated as sale of individual asset of the business rather than a single asset sale. So it means when you are selling the complete business, right? In that case, you will be identifying the individual assets you are selling and consider the gain or loss on the individual assets rather than considering that as a blanket sale. So you should not consider the sale of business as a blanket sale and calculate the overall gain or loss. Rather, you should do individual calculation of the sale of respective assets. And accordingly, you need to calculate the capital gain or loss. Make sense? Now, shall I draw some example for you?
That is in scale, in terms of small businesses or any.
Any businesses. Maybe let me draw an example really quick. So, 1 second. My system is slightly slow today. Okay, so let's assume this is business A corporation, right? They have, let's say, land, they have building, they have furniture, they have automobiles, they have account receivable, they have uh, uh, inventory, right? They have, let's say, account payable, right? And they have loan. Let's assume this all is in their balance sheet, right? Let's say 100,000, 50,000, 10,000, 20,000, then you have 5,000, let's say 5,000. Then you have account payable, let's say 10,000. Let's say you have loan of 50,000. So let's assume this is your net asset. Right? So far, so good. Now you have sold the business for $150,000, and another example, let's say $100,000. Are you guys with me? So in this case of scenario, how much is the gain or loss? You might be saying this minus this is your gain, and this minus this is your loss, right? This is what upfront it looks like. Yes, no?
Yes, sir.
Right? But actually, how you need to do the calculation is, let's assume this account payable is for inventory, and balance 5,000 is, let's say, for automobile. And this loan of $50,000 is, let's assume, for this. So then your net asset is equal to sum of this net asset is this, right? And now you have sold all this for 150. So what will be the proportionate? So this multiply by 150 divided by 130. So this will be your sales price. Are you guys with me? Garima, Divya,
Yes,
Shiva.
sir.
Right? So this is sales price minus. So this is your gain or loss on the individual item. Same way, if we do this, your 0225 fix. So, sorry, the formula should be to 35 by 4, where with this, and this. Right, this is how you will be calculating the gain or loss on individual asset. Are you guys with me? Vivek?
Yes, sir.
Garima? So this is how you need to calculate individual gain and loss, right? I'm now looking at second scenario when the sales price is $100,000. So in that case of scenario, this 50,000 multiplied by 100,000 divided by 130,000. So this is how you will be calculating, and then gain and loss will be this minus this. So this will be a gain and loss, right? When it is 100,000, so you have 30,000 loss, and that loss would be allocated to these individual assets. Make sense? Yeah. Garima, Vivek, Shubham.
Yes, sir.
Yes, sir.
So this is what it means. The sale of business treat as individual assets of the business rather than single asset sale. So it should not be considered as a lump sum sale. It should be considered as individual asset sale. So allocation of the basis and sales price to be calculated using residual value method. So this is what it is, residual value method, right? And here it results into ordinary profit and gain, whereas this results into capital gain or loss. Any doubt so far? So far so good for sale of property?
Yes, sir. Yes.
Okay, so now let's do a practical question, one more question. Under which of the following condition may the substantial understatement of income tax penalty be assessed a taxpayer whose earned income tax credit is disallowed? Under which of the following condition may the substantial understatement of income tax penalty be assessed a taxpayer whose earned income tax credit is disallowed? First one is a taxpayer whose understatement is greater than 10% of the correct tax and the amount owed is greater than 5,000. A taxpayer whose understatement is greater than 10% of the correct tax and the amount owed is less than 5,000. A taxpayer whose understatement is less than 10% of the correct tax but the amount owed is greater than 5,000. All the taxpayers listed would be subject to substantial understatement of income tax penalty. Is there any specific benefit given, or it is being applicable to all? If I simplify the question. Did you understand the question?
Yes, sir.
What is the call of the question? Under which of the following condition may a substantial understatement of tax penalty be assessed a taxpayer whose earned income tax credit are disallowed? In all cases, or is there any specific limit we have studied?
Yes, sir. All cases.
So we have not studied any limit, right? So there might be, like in earlier years, there may be some limit to get confused to the student. So this question came. But currently, if you see throughout like the entire tax law which we have studied, there is no such limit of $5,000 or 10%. Right? Hence the fourth answer is correct. Next question is Mr. and Mrs. Ben purchase. Oh, this is again same
ये
question.
repeat हो गया था.
Yes, so it's my mistake. I think this question was here. There is some typo. This question should have been here. Okay, 1 second. Okay, so now we are jumping on to the next topic, which is planning for education. So in education, hope you remember lifetime learning credits, which we have discussed, right? American opportunity of tax credit, that also we have discussed in chapter 3. Hope you remember them, or do you want me to quickly walk you through again?
Clear, sir, clear.
Are you sure?
Yeah.
Shivam? Divya?
सर AOTC में मैक्सिमम क्रेडिट 2500 और लाइफ टाइम में मैक्सिमम 2000.
Yeah. Right, and here like so just for the benefit of everyone, for lifetime learning credit, maximum limit is $2,000, and for American opportunity tax credit, maximum limit is $2,500. That we have studied in detail in chapter 3. Now, two more things here. One is Custodial Education Saving Account. Right, if you remember in chapter 3, we study about HSA, health saving account. Same way, there is a education saving account also. So there are two category of education saving account. One is Custodial Education Saving Account. Second is Qualified Tuition Program. So Custodial Education Saving Account is being like maintained by the trust or a custodian. And here it is being allowed the taxpayer can make a non-deductible contribution up to $2,000. That means the contribution can be made up to $2,000 by the individual for the designated beneficiary. That means if you have one child, you can make up to $2,000. If you have two child, you can make up to $4,000, so on and so forth. And withdrawal for a qualified educational expense is non-taxable. That means here you'll get the benefit of taxes when you deposit. And when you withdraw for the qualified expense purpose, then it is tax-free withdrawal. But here is the limit that your individual who is contributing to the ESA, Custodial Education Saving Account, should not have the modified annual gross income more than $110,000, or if you are filing jointly, then $220,000. Whereas another category is Qualified Tuition Program. So personally, if you ask me, this is of no use. Qualified tuition program. So here they said there are qualified tuition program which is being established and maintained by the state or eligible educational institute. But whatever you deposit would not be considered as a contribution or as a deduction. And whatever you withdraw for the qualified expenses would not be considered as a tax. So that means it is simply your saving account or your checking account. It means you are depositing on your own wish and you are spending on your own wish, but for a qualified purpose. And there is no limit for the taxpayer modified AGI or for the any contribution. Right, this is normal like your bank account. So you're depositing and you're parking the amount, set aside your amount for a qualified tuition expenses, nothing else. Last one is IRA distribution for qualified education expense. If you remember when we have studied IRAs, so there we have studied if you are taking the withdrawal of IRA either for the use of any medical purpose or for the educational purpose, then early withdrawal you are not required to pay any taxes or penalty. So that is also a tax planning can be done. So that means you can withdraw from the IRA for the qualified educational expense or qualified medical expenses.
कमल जी, वो जो दूसरे जो दो ऑप्शन गए हैं, ये वाले कॉर्डियल वाले और ये दोनों सेम ही तो हैं, बस 2000 का फर्क है।
No, 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 no. In the Coverdial Education Saving Account, the two up to $2,000 you will get the deduction. Whereas for qualified tuition program, whatever the money you deposit, you will not get any deduction. That's the main difference.
Okay.
Coming to the practice question, all of the following are correct statement about the balances that is maintained in the Coverdial Education Saving Account except. That means which option is not correct. First one is it generally must be contributed within 30 days after the beneficiary death. It generally must be distributed within 30 days after the beneficiary reaches to the age of 30. It generally does not need to be distributed within 30 days after the special need of the beneficiary reaches 30. All the answer choices are correct statement. So all of the followings are correct statement about the balances that is maintained in the Coverdial Education Saving Account except. What is the call of the question? What is the call of the question? All of the following statements are correct about the balance that is maintained in the education saving account except which one? You need to choose the best right answer.
ये सब तीनों करेक्ट नहीं है क्या, ये वाले स्टेटमेंट्स?
As all these three are being correct, so this is the best right answer because this statement is of no use.
Okay.
Right? So that kind of tricky question you may expect in exam. Right? Be prepared for such kind of tricky question also. The question, it's not required all the time. You need to select the right answer, but there may be possibility where all the answers are right, but you need to select the best right answer. Right? So far, we have covered the tax advice, reporting requirement, sale of property, planning for education. Now let's jump into the planning for estates. So planning for estate, there are 5 categories which you need to plan when you are planning for estate. First one is estate tax exemption, right? Hope you all remember state tax exemption, $11.7 million. That is once in the lifetime, right? This we discussed earlier also.
Yes, sir.
Right? Then gift is also exempt up to $16,000 per person and $32,000 for married filing if they are giving it together. Right? That also you can use for tax planning.
That is per year, na?
Per annum, yes, per year. So if you give the gift to an individual up to $16,000, that gift is not taxable in the hand of individual who is receiving. Right? Same way, if estate has been transferred to the beneficiary up to $11.7 million, which is huge money, right, is not taxable in the hand of individual. That is once in a life only. But here you need to be very careful when you are preparing for a return of married filing jointly, in whose individual name you should be claiming the estates. So that's very important for the tax planning purpose. So that if you are expecting in future for, let's assume, is husband and wife, so they are filing joint return. So now for any reason, let's say husband's grandfather has a great property, as well as husband's, let's assume, grandfather, grandfather is also have great property, but unfortunately he do not have any, you can say, son or daughter or any such descendant. So now in this case, this individual who is a grandson is expecting that estate of the grandfather's grandfather will also be transferred to him after his death. In that case of scenario, once his grandfather is expiring, so you can consider the inheritance in the hand of wife, so that you can also claim $11.7 million again for the grandfather's uncle death. Are you getting my point? Shall I draw an example? Mr. A, Mr. B, and grandson, let's say M, and grandson's wife, let's say N, right? So now they too file joint return, right? Are you getting my point? So Mr. A, let's assume, has a property. Mr. A is grandfather. Of M. And Mr. B is grandfather's M's grandfather's brother, right? And he do not have any descendant. And they have, let's assume, the property of, let's say, $15 million. And he also have property of, let's say, 12 million. And now let's assume Mr. E expire. And let's say Mr. A is of age 86 and he is also age of 88. Right, Mr. E expired. And then property has been transferred to him for how much? Right? Are you guys with me? Whose property of 15 million transferred to him?
Grandfather.
Mr. A, right? And now they are filing a joint return. So in this joint return, there's how much? 11.7 million they can claim, right? But this property inheritance they can claim in the name of N, as Mr. M is expecting additional $12 million might be coming in some time when Mr. B get expired. And then later on he can claim 11.7 million exemption from that also. That is called tax planning. Make sense?
मैरिड फाइलिंग जॉइंटली में तो फायदा बहुत है।
Yes.
मैरिड
Yeah.
फाइलिंग कर रहे थे ना सब MNN.
Shubham, say that again.
So for this, like the grandson M and N are filing married filing separately. Yeah?
No, if they are filing separately, then only M can claim once in a life. If they are filing jointly, then they can take this benefit.
Because jointly में जैसे वो फाइल कर रहे हैं तो jointly में M ने भी बेनिफिट ले लिया 11.7 का और N ने भी ले लिया ना.
They both can take. Yes, that's what the tax planning is.
Okay.
But if they are filing separately, then one person can take only once in a life.
Mm-hmm.
Next point here to consider is basis of property in the hand of new owner, right? So what should be the basis of property in case of gift or in case of inheritance? This also we have studied earlier in chapter 2. So it is just reiteration of what we have studied. So first one is for the gift property, fair market value just before the date of gift. In case of inheritance, fair market value on the date of death, or 6 months in case of assets are being transferred to the estate, right? Next is taxpayer can carry forward tax credit for charitable contribution. So if you recall, the charitable contribution earlier was 60% deduction. But during the COVID time, they made it for 2020 and 21 100% deduction, right? So here charitable contribution can be carried forward infinitely. So you can recommend your client to do more charitable contribution in this year and can take the benefit in subsequent year. Make sense? Are you guys with me?
Yeah, okay, sir.
What I said? Yeah, Garima, Vivek?
More charitable contribution.
Yeah, because normally the deduction on charitable contribution is 60% for cash contribution, but due to CARES Act in 2020 and 2021, they have increased the limit to 100%. So hence for 2021, you can ask your client to do more contribution as that can be carry forward infinitely. That means if you contribute more in this year, you can take the benefit. If it is going over and above the requirement, then you can take the benefit in the subsequent year. Make sense? Fifth point is taxpayer can plan to pay long-term care insurance that cover the service needed in future. So normally we consider health insurance and medical insurance, but in addition to that, you can advise your client to take additional insurance for any future expected, life disease you may foresee. So that also being provided additional health insurance benefit as a deduction, itemized deduction, and that can be save the future expenses. Right? So these are planning of estate. Let's take a question over here.
Yes, sir, I have a doubt on page 118.
Page 118. In the book or in the notes?
Notes, sir.
Yes.
सर ये जो इसमें ये लिखा हुआ है, जैसे ये चैरिटेबल कॉन्ट्रीब्यूशन के ऊपर ही है, तो सर जैसे चैरिटेबल कॉन्ट्रीब्यूशन में कैश डोनेट कर रहे हैं 100% ऑफ एरिया, जैसे कैश हमने डोनेट करा हुआ $100,000, 100% ऑफ AGI, क्या मतलब हुआ फिर इसका?
अप टू 100% ऑफ AGI।
up to 100%। अच्छा, जैसे कैश चाहे हमने ज्यादा डोनेट करा हो, लेकिन अप टू 100% ऑफ AGI ही डिडक्शन मिलेगी हमें, है ना?
यस।
ओके। और सर ये लॉन्ग टर्म कैपिटल गेन प्रॉपर्टी, जैसे हमने कोई प्रॉपर्टी डोनेट कर दी हो चैरिटेबल
Yes,
कॉज,
yes.
ओके।
So if you are, for example, to the trust or maybe to the church, you have donated a car,
या
or maybe you have donated any land, piece of land to the church. So that comes in the long-term capital gain.
या सर इसमें सर अप टू वर्ड नहीं था ना, तो सर दैट्स व्हाई आई गॉट कंफ्यूज्ड।
Sorry, my bad.
ओके सर, ओके, थैंक यू।
Right. So let's do one quick question over here. Which of the following statement concerning the deduction of estate tax by individual is true? The deduction of estate tax can be claimed only for the same tax year in which income in respect of descendant must be included in the recipient income. Individual may claim the deduction of estate tax whether or not they itemize deduction. The estate tax deduction is a miscellaneous itemized deduction subject to 2% limitation. None of the answer choice is correct. So just look at the question again. All of the question is, which of the following statement concerning the deduction of estate tax by individual is true? So if you look at the option number 2, individual may claim a deduction of estate tax whether or not they are itemized. Is it an itemized deduction? The answer is no. Right? Hence the second option is incorrect. Third is like the estate tax deduction is a miscellaneous itemized deduction. So again, it's not a miscellaneous itemized deduction. So this also incorrect.